talk about probably what's going to be the most interesting topic of the morning. Of course, I'm talking about depreciation. Let's talk about depreciation. Actually, there are just a couple of things you need to understand, but they are critical. Let me ask you, starting on page 14, we're going to do this on pages 14 and 15. That's all we have left before lunch. But what is depreciation? What is depreciation?
Loss of value over time.
That is exactly what it is. Somewhere on page 14, write that. That's exactly what it means. Loss of value over time. So things get used up in the business, right? So now the matching principle says what? Just to read that little thing at the top of your page 14 there. What does the matching principle say about expenses? Let's just remind ourselves what that is. Remember that one?
Matching principle, yeah.
The matching principle tells us that expenses should be lined up with the revenue they create. So we have these big things that we use in the business, right? Vehicles, buildings, manufacturing equipment. Let's take a vehicle. We buy a delivery vehicle for $20,000, right? Now, we might have paid cash for that. We may have financed it, whatever, it doesn't really matter. But we take the $20,000 we just spent on that vehicle. Would the matching principle say, A, you should just show that as an expense when you actually spent the money? No. The matching principle would say what? Yeah, spread it. Amortize it. Spread it across its what? Useful life. That's what the matching principle would say. Because let's say for the next 5 years, this vehicle is going to contribute to producing the revenue and the profit associated with running the business. And that's what depreciation is. But I need to introduce you to a couple of terms. You guys see down there where it says capitalize. This does not mean to take a little letter and turn it into a big letter. Within the context of what we're talking about here, we might have an element of expense related to something that's going to last a long time, like a $450 laptop computer. Well, because it's only $450, even though it's going to last 5 years, we're probably just going to show the expense for that computer when we actually buy it, because it's a small item. It doesn't meet the GAAP or generally accepted accounting principle threshold of what we call materiality. So we're probably just going to show that as an expense when we buy it, but not this car, not this delivery vehicle, right? What we're going to do with this delivery vehicle is we're going to put it on the balance sheet as an asset, and we're going to show its use over time, all right? So what I want you to write down in terms of capitalize is put a cost on the balance sheet as an asset. Write that down. That's what capitalize means. Put the cost on the balance sheet as an asset. So just a couple things about components of depreciation. Let's just talk about those real quick, because there are guidelines in terms of what costs get rolled up into the total cost that gets capitalized and depreciated versus certain other related costs that don't. So costs that do get included, of course, those things that the purchase price of the asset, the net purchase price. If you're actually spending money to have it installed, that's going to be included in the price of the asset that gets rolled up and depreciated. Any sales tax or shipping costs, that will also be included. But here's some related things that are not included in what's rolled up into an asset. Routine maintenance, either in the form of routine maintenance to keep it running or in the form of extended warranties or service contracts, not included in what's capitalized and depreciated. If you have to spend money to get people trained to use the new asset, That's not included in what gets capitalized and depreciated. And if you have material, like if you've got to run a bunch of candy through a new machine to get it up and running right, all of that material that you run through the machine to get it tuned up is not included. We call those startup supplies. Pretty clear on that one? You guys can reference back to this when you do a little example here in a minute. Because I'm serious about getting this birdhouse company going. We got a couple of things to think about, okay, as we do that. Useful life, what's that? How long it lasts. Write that down, how long it lasts. Now actually, you get a little guidance on that, okay? You get guidance from a couple of different sources, and I'd like you to write those sources right now. You get GAAP guidance, just write GAAP. Now the good news for you is if your internal accounting people actually do your books or certify your books or do your taxes, if you're big enough to have people that do that internally, they've got these guidelines. They know what they are. If you have your stuff done externally, either taxes, books, or otherwise, then your accountant, your tax accountant, your bookkeeper will have access to this information. But let me tell you where it is. Generally accepted accounting principles are actually overseen by an organization called the Financial Accounting Standards Board. Don't write that whole thing down. Just write FASB, the Financial Accounting Standards Board. And if you ever want some really good bedtime reading, go out to this website, www.fasb.org. And one section that website will have is guidance on what the useful life categories of certain assets are. Now, those guidelines actually make pretty good common sense. They'll track with the way you would think. Like a vehicle. How many years do you think a general vehicle that you use in your business would last? Maybe 5 years, and that's pretty close, right? How about technology like servers or larger computer expenses that you would actually capitalize and depreciate? 3, yeah, 2, 3, 4 years maybe, right? How about manufacturing equipment? Way depends. I mean, you're going to get some information from the manufacturer. Whoever gives you the equipment could be 5, 6 years, could be 15 years, depends on the nature of the equipment, okay? How about buildings? Longer, 20, 30 years, right? So those asset categories will track with that, and either your accounting people know it, or you can get access to it at fasb.org. Now that's that set of information. Generally accepted accounting principles give us what kinds of guidance? We want these statements to be what? Clear, fair, accurate reflection. So we want them to track, follow these principles, right? There's another organization that doesn't always make rational sense, who will also give you guidance on depreciation guidelines. The IRS, write that down, irs.gov. irs.gov. Now, I will tell you that in the areas of asset accounting, really the only places that the IRS kind of differs is in a category called Section 179, accelerated depreciation. Just write that down, accelerated depreciation. Does anyone know what accelerated depreciation is, or what it does, or what the purpose of it is? Yes, sir.
Your depreciation at once.
Or earlier in the life of the asset, right? Generally not all at once, not all in the first year. That would just be like expensing the asset, but in a much more accelerated. Now, why would it be an advantage to you, as someone who pays taxes, to get more of the depreciation earlier in the life of an asset? Okay, so if your depreciation expense is higher earlier in the life of an asset, then what's going to be lower? Your taxes are going to be lower. They're going to be lower earlier in the life of the asset, but they're going to be higher later in the life of the asset. It's going to add up to the same amount, so why is getting a tax break better earlier in the life of an asset? Maybe cash flow, maybe if you want to sell it. Well, the big reason is, and I'm not going to go into this area, so don't get all nervous on me or anything, okay? It's because of the time value of money. Because of the time value of money. $1 today is always better than $1 in the future. A tax break today is always better than a tax break in the future, generally because of the time value of money. Let's blow the smoke away from all of this and put your minds at ease right now and just tell you this, that generally when you're producing your books, you're going to use the GAAP asset life category and the GAAP guidelines to produce your books on a monthly basis. Now the end of the year comes and it's time to do your taxes. Either the internal folks that do your taxes or your external CPA, if it makes sense to restate your depreciation to take advantage of an accelerated depreciation associated with tax break, who's going to do that for you? Your accountant's going to do that for you. But you generally need to know about accelerated depreciation and what that's all about. Does that make sense? Okay, I think I have something called salvage value down there. What is salvage value?
Once you've depreciated an item fully and you go to sell it, how much you're going to receive for that.
And when do you have to actually estimate what salvage value is going to be if you're going to set it up with the salvage value? In the beginning part, right, when you're setting up your depreciation. Do you know what most people assume salvage value is going to be for their assets? 0. So just write that down next to salvage value. Generally assumed to be 0.